opportunities in institutional quality, recession resilience real estate. In February 2020, BAP United launched its first offering of the year, a $100 million apartment building acquisition project, which is focused in Chicago's South Side. Thank you again, Tosin, for taking time out of your schedule to be here with us. You may begin.
All right, thank you very much for having me here and for giving me your time. So just to give a little bit of background on me, I've been in real estate roughly about 7 years as a standalone individual. I did grow up in a household where both my parents practiced real estate from a very, very young age, so I was always around it. But as far as being on my own and solo, it's been about 7 years. Initially, the way I got into the business was, my parents did a lot of single family investing. So, my mom would buy single family homes in quote unquote hood areas of St. Louis, Missouri. She'd fix them up and then rent them out to elderly Section 8 tenants. My father was a bit more ambitious. He actually bought apartment buildings. So by the time he was 25, he had about 207 units spread across multiple buildings. And he also had an office space. And so him being 25 years old and doing this, and I must have been, I don't know, maybe 4 or 5 years old, something around that. To me, it just seemed regular. It didn't seem like it was anything out of the ordinary. So when I did get older, I kind of, told myself I kind of wanted to replicate what he was doing and kind of get into the multifamily apartment building space. However, I didn't start there. The first few properties that I bought myself, they were what's known as arm's length transactions, which basically means that you have a prior existing relationship with the seller. So I had built a nice relationship with the city hall, the zoning department of Newark, New Jersey, the town where I was living in at the time, and was able to get some properties from them for literally next to nothing. And, my plan with those properties was to just hold them until values grew, sell them, and then use that capital to go and buy bigger assets and bigger properties. And so that's what I eventually did. I think the last property that I sold that I bought from them, I sold that in June. And I literally made 75 times on the sale than what I actually bought the property for. So it was a huge, it's probably the biggest percentage return I've ever made on a sale in real estate ever in my life. And probably won't do that again. Like those don't really happen all the time. So, but yeah, so right now it's more of just buying and holding. Currently right now, my portfolio is about 120 units, with most recently a 22 unit that I purchased in Montgomery, Alabama with a partner. We're in the middle of renovations there. So what I kind of want to focus on to everyone that's in the group now, or everyone that's in this conference, is why commercial real estate is way better than residential real estate. So I was looking at your IG story earlier today, and you made a poll, and you said commercial real estate or residential real estate, and like 81% of people said residential, and that right there is one of the biggest issues and problems, is because people don't understand why commercial real estate will always be better than residential real estate. One of the reasons you can grow your portfolio faster with commercial real estate. Commercial is not just office space and restaurants. Commercial is anything that's over 5 units, even if it's a building where people live in. So a lot of times we think that residential is anything where people live in, but no, residential is only a single family home up to a 4-unit building. That's what residential is. So to build a huge portfolio or to build wealth only investing in residential real estate, it's going to take you so much longer, and that process is going to be so much harder because you're buying small pieces of the puzzle. And so it's better to buy bigger pieces, and you can just build a bigger portfolio. For example, I'm never ever going to buy a 4-unit building ever again in my life. It makes no sense. But I will buy 20 units. I will buy 22 units. I'm looking at a 113 unit in Chicago now. So when you have more units, you can grow your portfolio faster. You also have more income coming in. Perfect example. Let's say we're investing in residential real estate. We have a 4-unit building and we're charging $1,000 per unit for each building. That's only $4,000 gross revenue that's being brought in a month. Let's say your mortgage and property management and expenses for taking care of the building typically come to about 50% of what your gross revenue is. So of that $4,000 that you're making a month on that building, 2,000 of it is going to go towards paying your mortgage, your property management, expenses, reserves, and all that stuff. So you're making $2,000 net a month. 2,000 times 12 months, that's 24 grand a year. Now, I mean, that's not peanuts, but that's not what we're getting into real estate investing to do, not to make 24,000 a year. So if you now look at a 20 unit, right? Or let's just use a case in point, this 22 unit that we just purchased. The average rents are between 750 and 900 a month. So let me just do this calculation real quick on my phone. So let's just say average 800. So 800 times 22, that's $17,600 a month in gross revenue. So if we use our 50% for expenses and debt service and all that stuff, divided by 2, that's 8,800 a month net from one building. Times that by 12, that's 105,000 a year that I'm getting from one asset because I just bought a property that had more units. So 105,000 a year as compared to 24,000 a year. So if you're making sure that the properties that you're purchasing are larger unit properties, in a few short years, 5 years, 6 years, 7 years of buying right, you can actually get to a situation where you're making $1 million a year off of just your real estate assets alone. Things that you don't have to wake up and clock into work and trade your time for, et cetera. So that is one of the huge benefits of purchasing, commercial real estate and focusing on only commercial real estate. Another reason why it's important, if you have a 4 unit and something like COVID happens, right? Where the government is giving tenants 90 days to not pay your rent, you got 4 tenants that can say, you know what, we don't have to pay this guy rent for however long this whole pandemic happens. Or let's just say there's not even COVID. Let's just say, you're living in an area where, your 4 tenants lose their jobs, or your city, the biggest factory or the biggest employer shuts down, and now your 4 tenants can't pay you rent, and you got to figure out how you're going to evict them and replace them. Because you only have 4 tenants, that's not a lot of tenants. Now, if you have a 20 unit building, what is the probability that 22 of your tenants are going to have some type of life altering situation to where they can't pay you? So it's the higher you go, the bigger you go, the less likely that you're going to have no income coming in. Even if you do have a situation where, 10 out of 20 of your tenants aren't paying you, hey, you're still pulling in $5,000 a month net profit after all expenses. That's 60 grand a year. It still allows you to sit back and figure out, okay, how are we going to pivot? How are we going to handle evictions, or how are we going to cancel leases? How are we going to pivot and move forward without you being scared, thinking, can I pay my mortgage and be at risk of your building being foreclosed on? So that's another reason why you want to go higher units in commercial real estate. Another thing with commercial real estate and what's called a mixed use property. So these are properties that have residential units and commercial storefronts. So if you ever see a building that has apartments up top, but on the first floor, there could be a Dunkin' Donuts or a Starbucks or a tax office, those properties are called mixed use properties. Those are even better in hedging against, inflation or bad economy or anything that could happen, because typically the storefronts on the lower levels, they have higher rents because these are commercial leases. And a lot of times you can charge commercial tenants more money based off of the type of business. So if I have 15 apartments up top and I have a Dunkin' Donuts on the first floor and a tax office on the first floor, I know, okay, Dunkin' Donuts, you guys are probably doing, $150,000, $200,000 a month in gross revenue from selling coffee and donuts. So I know that you guys can afford to pay me $5,000 a month for this space. As if it was a mom and pop donut shop, I may say, you know what, you guys don't necessarily have the brand recognition. You're not as big, just give me $1,500 a month. And so you price your rents not just based on the location or the area, but based off of who your tenant is going to be. If I'm getting a Starbucks or a Dunkin' Donuts or some huge, large multinational brand, I'm going to charge them the highest rent possible, because as an investor, I need to be able to, make sure that my bottom line is going to be as high as it can be. And so when you have a mix of commercial tenants and residential tenants, then, if you have a situation where, some of your tenants fall on hard times and can't pay you rent, the income coming from your commercial tenants who have to be in business every day is going to help you push through. And so it's just a best way to kind of make sure that you're mitigating the risk when you're actually getting into real estate. Cash flow, the cash flow from commercial properties, because it is significant higher than the residential 1 to 4, it allows you to be able to buy more properties every other month, or basically grow your portfolio at a quicker, faster basis without using your own money. When you buy your first property, you're probably going to be using your savings. You're probably going to be using money that you're getting from family or friends or people that are putting into the pot, and you guys are buying something together, right? That's money that could have taken you a couple years to save up. Once you buy your first commercial property, you can now use the income, the net profit from that property, and use that to now acquire other properties so you can move faster. And so that's one of the ways that, or that's one of the reasons why I prefer commercial property, because, my goal is to be at 1,000 units in the next 18 to 20 months. In the next 3 to 4 years is to be at 5,000 units, specifically because I want to create the type of cash flow that I can pass down to my family, that can take care of my family, my mother, my father, as they get older. Even though they're probably never going to stop running their businesses, I firmly believe that both my mom and dad will happily die working, or happily die building their businesses, because it's just what they love to do. But just to have that, just for them to have that peace of mind, knowing that they have a son that can support them in any endeavor they want to do, and that the price or the cost is not going to be a factor. Very, very important to me. I also have a huge family. I have a lot of nieces, nephews all around the country, not just in States, but back home in Nigeria, in London. And, I want to be that person in the family that can fund and support any of the family's goals of building businesses in other, places of the world, or in other endeavors. Or if there's a nephew that grows up one day and he wants to get into the tech business and he needs a small loan of $1 million, I want to be the uncle that can provide that. I want to be that person that can help my family, and my last name, which it's actually pronounced Oduwole. I want the Oduwole name.
Well, hold on. You said validation, and we both agreed it was guided. So that's the question. Are you looking for guidance and validation?
Okay, cool. So that's one of the reasons why I prefer commercial real estate. So we've kind of gotten that out of the way. So how do you acquire a commercial property? So it's typically not, it's actually not the 3.5% down FHA loan that we hear about all the time. FHA is specifically for owner occupy residential real estate. So that's for real estate between 1 to 4 units. Commercial property, you're looking at traditional mortgages or private lenders, where they typically ask for anywhere from 20 to 30% down. If you're a new investor, you're a new buyer, you've never done this before, the lender is probably going to ask you for 30% down, because it's a higher risk for them. They're going to, lend you 900,000, 1.5 million, 2 million to go and buy a large asset that you've never ever managed before. This is your first time. So they're going to want more down. They will be able to go down as you get more properties, more deals, and you can show a track record of cash flowing and managing properties correctly. Then your down payments will get down as you start building relationships with those lenders. That's why it's very important that you find a good lender and you stick with them for at least 5 or 6 properties, because you want to build that relationship. You want to use them to fund 5, 6, 7 deals in a row. That builds the relationship. It gives you leeway with them. You can start asking for certain things. I've seen certain investors that have done 30 or 40 deals with the same lender, and they come in and say, you know what, we don't want to put anything down. We want to put 0 down, and the bank will do it, because the bank has built this relationship knowing that they're buying properties that are cash flowing, that are appreciating in value, and they're able to, bend the rules a bit or bend the policies for that investor, because that investor is putting cash flowing assets under their books, right? So it's all about really just building a really good relationship with that lender. Typically, you want to do, 4 or 5 deals straight with the same lender before you start building relationships with other lenders. You do want to have relationships with multiple banks and multiple lenders, but it kind of takes time to do that because you have to do, a certain amount of deals with each lender over time. So, yeah, so typically as far as, hold on, let me look at some of these questions. I think there's questions coming up. But typically as far as your down payment is concerned, it's going to be between 20 and 30%. When you are looking for commercial properties, you want to find a commercial broker, number one. And there's going to be some questions you're going to want to ask this broker before you actually have them go out and start finding deals for you. Number one, you want to make sure that they specialize in commercial real estate and working with investors. Specialize. Anybody who has a license can help you find commercial or residential, but just because they have a license and can go and find some properties for you doesn't mean that's who you want. To kind of make the analogy, would you want a dentist who just became a dentist yesterday and can operate and pull your tooth out, right? Or do you want a dentist that specifically for the last 20 years has focused on the area of dentistry that you actually need services on? You want the person who specifically only does that one thing. So you'll want to find a commercial broker who specifically only deals in commercial real estate, and that has been doing so for like at least 10 years. I say 10 years because in 10 years being a commercial broker, there's a lot of caveats. There's a lot of in and outs that you're going to learn. You probably would have seen all the ups and downs and all the pitfalls that can hurt your clients. And so you're ready and prepared for that. And so you're able to kind of walk your clients through, making the best decisions in their purchases. Number two, that commercial broker has to also own investment real estate themselves. You as a broker can never give me the best advice of buying property if you yourself don't buy property. It's similar to having a head coach on your basketball team who's the head coach of the basketball team, but has never played basketball before. That type of guidance from somebody who's never been in the game is disastrous. So you want to make sure that your commercial broker also owns real estate. And if they do, they would have no problem in showing you what their portfolio is because they want you as a client. They want you to believe in them and feel that you're in the right hands. So they would have no problem telling you what properties they have or even showing you their properties. If a commercial broker does not want to show you their properties, there's something wrong and I would run the other way. Just go find somebody else, right? So yeah, and then so number three, once you have found your commercial broker and you've kind of screened them, you make sure that they have the experience and that they also own a significant amount of investment real estate. You want to ask them if they have any commercial lenders that they can recommend, lenders that they've worked with or that their clients have worked with who have favorable terms or who are, the easiest to get deals done with. A commercial broker would know that because they've dealt with commercial lenders for however many years they've been in the business. So they would probably be a great place to kind of find, the first banks that you'll want to build your relationships with. Number four is knowing what city or what area to purchase property in. A lot of people make the huge mistake and they want to buy property in the city where they live. That is one of the hugest mistakes ever because the city where you live may not be where the best deals in the country are. So if you live in Atlanta, Georgia, or you live in a New Jersey or a New York or a DC or a Houston or an LA, Miami, these are the worst places to buy deals because they're so expensive and your annual returns are so low. So the sexy cities that everybody likes to be in, those are the worst places to buy because those markets have already come up. So now is not the time to buy. The best time for you to buy in those cities was 10, 15 years ago. So you want to buy in cities that are 10 to 15 years away from becoming an Atlanta, a Houston, a Miami, a Chicago, a New York, etc. And so those markets are what we call second tier and third tier markets. The Cleveland, Ohio's, the St. Louis, Missouris, the Cincinnati's, the, I would even say some towns, some cities in North Carolina. and those are where you're going to find the highest return on your investment. I know I mentioned Chicago as a first tier city. So I invest in Chicago specifically because Chicago is a first tier city that has second and third tier prices. Okay. I'm not sure how that even is even so, because it is a major city. They call it the New York of the Midwest. The population in Chicago grows with a lot of the surrounding small town people moving to Chicago. Chicago has a lot of the largest financial companies there. They have their own stock exchange. So by all accounts, Chicago should be priced at what a New York is, but for some reason it's not. Recently I've seen buildings in Chicago that are, 6 units, 12 units going for 380,000, 390,000, which is amazing. A 6 unit or 12 unit in New Jersey, the market where I started, you'd be looking at almost 900,000, maybe even $1 million now. And so being able to be in a market to where you can grow a portfolio at, second and third tier prices, but be able to charge first tier rents is amazing. So that's why I personally like Chicago. But the cities you should be looking at are typically the Midwestern cities, those middle America cities, the cities where there's a lot of blue collar workers. Those are the towns where you're going to have steady income, steady jobs. You usually have majority of job loss in the major cities. The LAs, the New Yorks. When something happens to the economy, those are the places that typically take the hardest hits, because those cities aren't really based off of like particular products. They're based off of services, financial services. When you go to the Midwest, it's more of a lot of farming. There's more of textiles. There's more industry in middle America. And so regardless of the economy going good or bad, those don't really stop. Factories don't necessarily shut down because the economy is going bad. People still need food. They still need toilet paper. They still need clothing. So there's certain industries that, no matter whether we're in a good or bad economy, even if those industries slow down, they don't cease. And, in the major cities, sometimes a lot of the products and services that are offered there, they may slow down or even stop for a time during economic hardship. So that is probably, the basic rundown of why you want to invest in commercial real estate over residential, which markets you should pick, and then how you should go about finding those deals and analyzing them. As far as getting qualified for a loan, you would want to make sure that your credit's very, very important, extremely important. You want to really be in the 700s, right? Making sure that you're paying your bills on time. I just put my bills on automatic pay from a debit card in my bank account, just automatic pay it, so I don't have to always remember. Car notes, cell phone bills, electric bills, all of those things are very important. Even if they're small debts, they all build history and showing that you have a tendency to pay on time. That is really the dummy proof way to be able to get low interest mortgages when you're buying very expensive property or high price property. Another way is that you can, if you have family members that have good credit, you can have them put you as an authorized user on their credit cards. They don't have to give you the credit card. They can just put you as an authorized user. They can keep that credit card that has your name on it under their account. They can keep it in their drawer at home. They don't need to give it to you, but their good credit will not be passed on to yours. And so having that credit score of at least like a 705, 710 definitely puts you in a good space. And then having your 20 to 30% down. And then there's one more thing. Sometimes, depending on which lender you're going through, if you're going through like a Wells Fargo, like a bank, they may want to see 2 years of tax returns. So, they want to see that you have a job, that you filed taxes for the last 2 years. If you do go through a private lender or what's called an asset-based lender, who they lend based off of the property and what the property is making, not necessarily on your job history, then you'll just need your down payment, which is your skin in the game. Your 20 to 30% down lets that private lender know that you're not going to run away from this deal. And that's why they say, put 20 to 30% down as opposed to a 3.5% down, on a FHA loan. Somebody can walk away from 3.5%. You know, if you're buying a $360,000 3 unit and you only had to put 15 grand down, you know, if you made a bad decision and you bought the wrong property, and you know, some people may say, hey, you know what, it's just 15,000. Forget this mortgage. I'm not going to pay it. I'm going to let it go into foreclosure and I'll just keep it moving. A lot of people do that. You're not necessarily going to do that if you put $70,000 down into a deal. You're going to find a way to make the deal work. So that's how lenders try to gauge and to make sure that you're not going to just going to take the money that they give you to buy a deal and then run off. And so I believe there's questions here. I can't really see them for some. Okay, I think they're coming up here. Give me 1 second.
Yeah, you can choose to answer them now, or we can wait till the question and answer session, and then I'll read them to you, and then you can answer them. Whatever makes you feel comfortable.
So yeah, I mean, I've pretty much gone through, you know, why I think commercials is the best way to start. To be honest, it's not really rocket science. I really dislike when a lot of real estate teachers and gurus try to make this thing seem so complicated, because it's really not. You know, it can be broken down to anybody who has a half of a brain in 20 minutes. You know, so so I'd really like to get to any specific questions that people have, so I can kind of, you know, just kind of hone in on what issues people are looking for and what they're trying to get solved.
Sure. Okay. That was amazing, by the way. Thank you so much, Tosin. I've got a few questions of my own, and then I'll go to some of the questions in the chat room. So you said you started about 7 years ago, right? Did you ever have a 9-to-5 job, or
Oh yeah.
did you go straight into real estate?
No, I had a 9-to-5 job. I've worked probably 6 or 7 9-to-5 jobs. I was fired. I was either fired or quit, all of them. Except for the last one I had. That was when my real estate career started taking off, and my boss, we had a great relationship. That was actually, I was working like staffing and waiting for like private events. So like we did like weddings, bar mitzvahs. I'd be the guy that come out in the apron, pour the water and the wine, bring your chicken or your steak out. And the woman who owned that company, she was a Black woman, and she knew I wanted to get into real estate full time, and she really just literally started teaching me the back end of her business. She was teaching me how she did payroll, how she hired people, how she fired people. She would show me the actual checks that she was getting from the clients. So we go to a wedding venue, and you know, the people getting married paid the venue 60 grand for this wedding. That venue now pays my boss, the staffing agency, $20,000 for that night. We now, the workers, the waiters, we're getting paid anywhere from $15 to $20 an hour. And maybe there's 9 or 10 of us that are working that night. So for that night in payroll, she's maybe paying out about $2,000 to us, but then pockets the 18 grand. And we're doing all the work. So she was showing me how it was actually running, and how, you know, I may be paying you $20 an hour, but I'm billing you out for $100 an hour. So every hour that you work, you're making 20 bucks, but I'm making 80 bucks. And so she really kind of opened me up to the hospitality industry and the restaurant space. And it was because of what she was able to teach me that I actually bought a sports bar in New York about a year later. And it was really because of everything that she taught me. I knew how to run the front end and the back end of that business. So that was the last job I had, was working for her. Her name's Monique Spencer. She runs a la carte staffing out of New Jersey. My first job, I worked at a fast food restaurant called Jack in the Box. They have them in the Midwest and the South. They're not nationwide. It's basically like a fast food burger joint. And they also have tacos there too. So I was cooking tacos. I was in there frying the tacos, getting burnt by the oil. I hated that job. I worked there for about maybe 4 weeks, 4 to 6 weeks, and I made up some reason I quit. But then I realized that, hey, you know, I'm 20 years old. I need money, man. So I went and got another job at a restaurant called Sonic, which is like where you wear like roller skates, and they serve the people on roller skates and stuff. And so I was in there in the back cooking chili cheese hot dogs. And that one was a funner job because a lot of my friends, we all worked in the kitchen together. So we would just be back there clowning and having fun. I got fired from that job because I guess the manager just didn't like how I was just having too much fun on the job, and I wasn't making, you know, making chili cheese dogs the passion of my life. And and so I got fired from there. Let me see. Next job, I was working at Banana Republic, no, and Taylor Loft. in the Short Hills Mall in New Jersey. That was like it's like a clothing store for middle-aged women. Okay.
Oh,
And so I was literally one of two men that worked there. Everybody else were older women. And when I tell you that older women, they sexualize younger men the same way that women accuse older men of sexualizing younger women. It's like you literally feel like a piece of meat every time you go into work and your 45-year-old manager is just looking at you like she wants to rip your clothes off or whatever. So I was working there for about 3 months. Ended up getting fired from there. One day I have asthma. And so there was a time that I had an asthma attack the night before. And so when I came into work, I wasn't as quick and as fast with like folding the clothes and whatever. And then the following day they fired me. And so I just looked at it. I started seeing these situations, and I made a video about this situation and posted on my Instagram and actually tagged Ann Taylor Loft, and I titled it the time I got fired from Ann Taylor Loft. And it really opened my eyes and said, I never want to put myself in a position to where somebody can take away my income for any reason just because they
yeah,
feel a certain way. It's like, yo, I can't live like that. So you're going to be able to decide whether my money is coming in or not. And I just felt like, you know what? At that time, I was 20, 28 or 29. And I realized I was like, yo, I'm never going to have a job, or I'm going to get out of having a job as quickly as possible because, it's just not the way I want to live. And so after that, I worked at Banana Republic, which was in another mall, which was in Jersey Gardens Mall. And I worked there for maybe 6 months. That was really the turning point for saying, you know what, this job thing isn't really for me.
for you.
Yeah, it wasn't because it was bad. It was a great, like a lot of my coworkers were people I went to college with. My managers were all cool, fun people. It wasn't like, I was being treated like a slave in there or whatever. It was a great place to work. But I just realized that one of my friends came in one day. She had just got hired. We went to college together. And she just got hired, and she came in and she was really excited one day. She was like, hey, Tosin, like, I sold $1,500 worth of clothes today. And in my mind, I'm like, okay. I'm like, why are you happy? Like, we get paid the same. We get paid $12 an hour each. You got paid $108 today. So why are you happy? Because you sold $1,500 worth of clothes for them. And I said, if you were going to make me $1,500 in a day, I'd pay you $108 too. You know what I mean? And so when I realized, it's like, yo, we're really in a machine, which it's fine. Like, we're really in a machine to where the value that we're creating is not the value we're being paid.
Sure. Yeah.
And that happens at all levels. Even if you have a high paying job, even if you're a surgeon at a hospital and you're making $500,000 a year, you're doing heart surgery that the insurance is paying the hospital millions of dollars for. And they're giving you $500,000 per year, and you're doing heart surgery, lung transplants, amputations. You're doing all this stuff that the insurance company is paying the hospital millions and millions and millions of dollars for, and you're getting paid $500,000 a year is a great income. That's a great salary, but the value that you're creating is not the value you're being paid.
Sure.
So I felt that I didn't want to be in that position anymore, and that I wanted to get paid for the value that I provide. So if I'm providing high quality, safe housing, I want to get paid for it.
Yeah.
And so, I'm not a slumlord. I'll never have a building where, there's mold or there's unsafe. I believe in creating the best quality high housing at the price point for anybody who's going to be in my building. Because if you're going to live in my building and you're going to have your children there and your family, it needs to be a safe place. My name cannot be attached to slum housing or whatever. But in return for providing clean, quality housing, I am going to get paid for the value that I'm creating. And so that's why,
Awesome.
kind of.
Thank you for that. So we've got a few questions on the line. The first one, Susan Olalikon. I'll read your questions, and if you have any follow-up questions, just get ready. So the first question from Susan is, so where should a new real estate investor begin? 4 units, 22 units, someone that just starting afresh, it might be a little bit scary to kind of jump into those 22 plus units, right?
Yes,
So
so no, so scary is all relative. It's scary because you've never done it before. The same
correct.
process that you're going through and buying a 4 unit is the same process you're going through and buying a 22 unit. So a lot of times, because there's a higher number, we make it seem like it's a harder thing. It's actually easier to get into larger units than it is for lower units, because there's more underwriting at the lower units when you're using the FHA. They want to look at your tax returns. They want to look at your DTI, your debt to income ratio, like all that stuff. When you're buying a bigger property and you're putting 20% down, the bank only looks at the bank only looks at your down payment, your credit, and the financials of the building that you're buying. And then immediately you get more money. So I always tell people, it's like the things that we've been hearing from real estate investors or teachers that are not giving us the whole truth is skewing our perspective on what it's like. Buying a 22 unit has less risk, more money, and less regulation to deal with. So I would say, do you choose a 4 or 22 unit? Depends on how much money you have saved up. If you have that 20% down to buy a 15 unit or a 10 unit, then go and buy that as your first property. If you don't have that much, start wherever you're at, but definitely start as high as you can.
Makes sense. So the second question is, should a new investor realistically be managing a 1.2 million asset from the beginning, even if you have the funds, right?
Why? So the way that question is posed, you're posing that question as if it's not possible for you to do that. Managing a 4 unit or a 20 unit is the same process. You're hiring a management company. They're taking 10% of your gross rents, and they're the ones managing the property. So why would you pose a question thinking that it's going to be harder or more difficult? It's the same thing. If I hire a mechanic to change the oil on my Rolls Royce, they're doing the same thing as if I'm having them change the oil on my Toyota Camry. It's just a different asset, but they're performing the same function. So yes, if you can afford to get into that $1.2 million asset, get into that, because that's going to make you more money. And we're getting into real estate investing to make money, correct?
Sure.
That's why we're here, to make the most amount of money possible. So why would we stay away from the assets that are going to make us the most amount of money possible? It's because we have these fears that we have gotten from, I don't know, preconceived notions, or taking advice from people who haven't actually invested in those assets and say, oh no, that's too big. You should crawl before you walk, or step your toe in first. And all that is nonsense. It's nonsense. And I want you all to be able to build a real portfolio that makes you wealthy. And if you're staying with 2 unit and 3 unit properties, I'm sorry, it's just not going to happen. You may over time, be able to create a nice stream of income and equity in your properties. But if you're trying to be a multi-millionaire, it's going to be a very, very long road for you if you're only buying 3 and 4 units.
So my follow-up question to Susan's question would be, what are some of the tools you need in your toolbox, right, to be able to be successful, right? So you've saved up, you have the funds, and you're ready to just go in. For whatever reason, 22 unit is what you can afford. What are some of the things that you feel you need to have in place?
Okay,
right,
so
to be successful?
the right team. So once you know you're in a position to buy something like that, you want to start streaming for your team, because you may own the property, but you're not the one that's going to be dealing with the tenants. You're not going to be cutting the grass. You're not going to be changing the toilets if a toilet leaks or whatever. So it's about getting the right team. So the easiest way to do that, if you don't know where to start, go on Google and type. So let's say you're in Atlanta, Georgia, right? I'll just use this example. And you want to find a property manager. Go on Google, type property manager, Atlanta, Georgia. There's going to be 20 or 30 that pop up. So this is where you have to work. You're going to call them and ask each property manager, hey, I'm about to buy a 22 unit apartment complex or apartment building. Do you guys focus on mid-size apartment buildings? If they say, oh no, we only manage single family homes. Okay, thank you very much. Click, call the next one. So you want to find a property manager who has at least 5 to 10 years specializing in the type of property that you're going to buy, because they're the ones that are going to be on the ground every day, leasing out the apartments, evicting tenants, collecting the rent, cutting the grass, painting when necessary and keeping your property in top condition. They're doing that, not you.
Right.
You are the captain of the ship. You're not the man in the engine room. The engine room is where all the grunt work happens. All you're doing is steering. You know what I'm saying? So understanding that and putting that in perspective, that you're not the one that's going to be doing the day-to-day work. So it's about getting a team, being an expert at hiring experts, the people that are going to be on the ground. So that starts with your property manager. Your property manager is really the most important thing, because they're the ones that are acting like you. They're the ones that are going to run the property as if it's theirs. So that's probably number one once you've acquired the property. And of course, in the beginning, looking for something, as I said earlier, you want a commercial broker who has experience and knows how to find profitable properties for you that you can pick from and see which one best fits what you're trying to do. And then your lender. So those are really the only three things you need: your broker, your property manager, and your lender. Those are the three things that you need to get into the deal. And then once you're in there, your property manager takes over. So your property manager must be a very good, reputable company. And that's why I say always they must have at least 5 to 10 years experience in the type of property that you're buying. Specifically, that if they're a sucky property management company, they're not going to last 10 years. If they've been doing bad business, you don't make it to 10 years by being bad at what you do. So that's one of the ways that I can kind of weed out, companies that, it kind of just lowers your risk. Property management company has been in business for 2 years. I'm sorry, there's nothing for us to talk about. Like, hey, I don't even want to ask you no questions, because that's too much of it. I don't know if you good or bad at your job. You ain't been in this thing for 24 months. So yeah, that's what I would say. I would really just focus on getting a really, really good property management, because they're the ones that are going to, be making sure that your property's being ran correctly.
That makes sense. So we have another question from Joshua Amino. How much capital would you recommend to have in starting with a commercial real estate property?
So, I mean, I would say if you had $100,000, right, and you wanted to buy something on your own, 100,000 is enough to get into a great deal. A great deal, because typically you won't need the whole 100,000. You'll probably roughly about 75 or 80, but you want to have another $20,000 to $25,000 for different things that you may need to do immediately. Like, you may buy a property and you may need to do some landscaping work that may cost like $5,000 or $6,000. So whatever you need as your down payment, you want to have like another 15 or 20,000 on the side, just in case there's little things that
something comes up.
Yeah. So yeah.
Okay. So a follow-up question: does the FHA program at 3% down payment allow you to rent the remaining 3 properties if you have a 4-property unit?
Only yeah, of course, but you have to live in one of the units. And so, I know that's a common thing that's talked about and preached about, house hacking. But look, this is the African Business Club, right? Yes. And Africans, we do things big, right? And we want to grow big. Don't go get an FHA. Don't go get a 4-unit. Just don't do it. Like, you don't have to do that. You don't have to do that. Go bigger. Go bigger. You can go bigger and make more money and get there quicker and have less. If you're buying a commercial property, you don't have to live in the property. I bought 22 units in Montgomery, Alabama. I'm never going to live in Montgomery, Alabama. I'm never going to live there, but I'll have assets there. Yeah. And when you look at a lot of the biggest apartment owners in this country, they put out a list every year of the top apartment owners. And a lot of them have like 60,000 units, 100,000 units. And I'm like, oh my God, these are massive portfolios. And a lot of times they're acquiring thousands of units every year. So whoever's at the top, it always fluctuates. So the small company that only had 5,000 units under management last year could shoot up to number 6. Now they have 50,000. So they acquired 45,000 units in 1 year. You don't do that by going with 4 units.
Yeah.
You do that by buying portfolios of 100 units, 50 units, 400 units. That's how you do it. So as a beginner, you can play that same game. You don't have to start buying 200 units, 300 units at a time, but you can start by buying 15 units, 10 units, 20 units. Get to 100 units as quickly as possible. 100 units at an average rent of $800 a month, that's what is that? Let me pull out my handy dandy calculator. You're looking at $80,000 a month in gross revenue. You can do that in 1 year. You can do that in 1 year. That's not something you can't do. So minus, your expenses at 50%, you're looking at $40,000 net a month. In 1 year and 18 months, you just built a $480,000 a year net real estate business with just 100 units. That's by 5 20-unit buildings.
Wow.
You can do that in 1 year. And so that's why I would say, I know we hear about the whole 4-unit FHA loan. Don't do that. You don't have to do that. Realistically, you can go higher. Realistically, you should go higher. If your goal,
if you can afford it, go for it. Basically,
exactly. Yeah, whatever you can afford, max. Buy the max of what you can afford.
So let me ask you this as a follow-up question from me. Do you ever travel to all the states that you have properties and assets, or do you just kind of let that be managed by your property managers?
Oh no, I always travel there. So
Okay.
so the property manager is just there for after I purchase. But what makes me decide where I'm going to purchase is I drive there. So before I started buying in Chicago, now keep in mind, I grew up in Chicago for a piece of my childhood. So I was kind of familiar with the city, but that was the 90s. It was a totally different city in the 90s as opposed to now. So yeah, I was going to Chicago. I mean, I still go to Chicago 3-4 times a month, but when I was actually looking to start buying there, I was going there 3-4 times a month. I'd rent a car, get a hotel, and I would just drive around the city. And I'd take meetings with real estate agents, real estate brokers, property managers, construction workers. I'd have dinner meetings with different contractors and just get a real feel for what's happening in the city. Is there going to be any growth? What neighborhood is going to boom? What neighborhood is not? What neighborhood is on the high end? What neighborhood is on the low end, but still has similar rents? And so you definitely want to do your homework on the area that you want to buy in. I would never suggest somebody buy blindly, but definitely buying out of state is you're going to be able to find better deals if you're opening to looking outside of what you actually do.
So a follow-up question to that would be, in your resident, city, you're more familiar with, what's going on, which areas, booming, like you said. But for something out of state, where do you go to find information about, the hot spots to buy properties, and places to avoid, because you don't live there, right? So you have to be able to know those type of information before you kind of commit your funds to it.
So I'd ask you a question. How do you do that in the city that you're in? You ask people, right?
Correct. Yes. Yeah.
It's the same thing. The same way, like even if you live in Charlotte, North Carolina, and you know the area, how'd you know the area? Because you met one of your friends as a real estate agent and told you, oh, this neighborhood is booming, or you saw something on the internet about an article. It's the same way. It's not like it's a rocket science thing where you have to have some secret way. So if you're thinking about buying in another city, then you Google commercial real estate agent in that city and you call them. You Google property manager that city and you call them. You start Googling any real estate trends or real estate articles that are happening in that city. You can type in what neighborhood is trending up in Atlanta, Georgia, and it'll show you what neighborhood is trending up in Dallas, Texas. You just see what the articles are and what they're saying, and you can have a pretty good idea of what areas or what zip codes in those cities you want to invest in. And then, you call those agents, you say, hey, I'm considering buying here. I'm going to be in town in 3 weeks. Can you show me around? I want to get your perspective on where I should buy, and you take that route. But it's just about asking people and then just, going out there and seeing for yourself. But it's something that everybody in this club is very capable of doing.
Makes sense. We have a question from Cliff. Let's see. Actually, we have one from Monica. Besides capital, what are some of the other factors lenders look at when deciding to approve a loan?
So if it's for a commercial loan, it's going to be your down payment, your credit, and sometimes your tax returns, just depending on which lender. So if you're going with a big box bank like a Wells Fargo or a Bank of America, they're definitely going to want your tax returns. And so they may say, hey, you have the down payment and you have the credit, but you didn't make enough last year on your tax return. So they may deny you and not allow you to buy something as big as you want. But with private lenders, That's why I like private lenders better, because they don't care about your job. They don't care how much money you make on your job. They care about, is the down payment there? Is your credit there? And are you buying a property that's going to allow you to pay us back and still turn a profit and grow a portfolio? So private lenders are like, they exist for investors. Big box banks, no, they exist for consumers, for the grandmother that's going to open up a savings account and just put their money in there. And then they're going to take your money and lend it out as credit cards and whatever. So the big box banks are there for consumers. Private lenders are specifically there to do business with investors.
All right. We have one from Pajamas Investor. Do you often travel? I think we covered that already. From Marion Abbas, what's your take on having a partner or partners in order to increase capital for commercial property down payment?
Yeah, I think that's an amazing thing. That's probably one of the best ways to get in, if you do have some partners that you can trust. And yeah, it's easier to pull that capital in and, you know, buy a property or two with a team of people. And then once that cash flow is coming in, and of course you guys are splitting it up, however you guys have agreed to split up the profit, then, you know, now you can now take that money and go buy your own deal and buy your own thing by yourself. So yeah, if you do have people that you can buy things, sure.
All right.
What's the message?
Sorry about that. So from Oluwole, what websites do you use to find commercial properties? I think you said Google, but are there any other platforms that you use to find properties?
Yeah, so I don't usually use Google to find properties. After I found a property, I'll use Google to see how much that building is renting out their units, because they always like will put, hey, we have 1 bedrooms from $700 a month or 2 bedrooms from $850. But as far as to find properties, I use something called realestatedealsystem.com. I'll type it here in the chat. So I use that. It does cost. It's $97 a month, but it allows you to put in a zip code of any city or put in a city and see every single property that's in that city, whether it's for sale or not for sale. So if you go on a Trulia or a Zillow, you can only see what's on there, right? And they only show residential properties. So you won't be able to find a 15-unit apartment building for sale on Zillow or Trulia. You know, but with realestatedealsystem.com, I can just put in a zip code. You know, I can share my screen and show you guys. Hold on.
Yeah, feel free.
Let me see. Give me one. Let me figure out how to do this. I just saw the share screen button. Okay, here it is. All right, let me just pull up. And I'll give you guys I'll give you guys an in-person look at how I do it. Just give me 1 second. It's just loading. All right. Oh, we got quite a few people in here. That's cool. 55. So share screen. How do we do this? Okay, so I just want somebody to just yell out a random city. Houston, Texas. All right, let's put in Houston, Texas. Oh, I spelled that. Houston. All right.
Chicago.
Hold on now. One city at a time. And so I'll go to the filter. So hold on. So it shows me that, let me click Houston again. So it shows me that in Houston, there are 943,942 properties in the city limits of Houston. Now, this shows everything: single family homes, commercial space, mixed use, whatever. But I want to see apartment buildings. So I go to the filter, go to property characteristics, go to property types, show me properties that are multifamily, 5+ units only. So now we have 4,394 in the city of Houston that are multifamily. Now I want to find things that are, maybe at least like 10 units. So I can go here and building size, square feet. Typically a building that's 10,000 square feet. No, hold on. 10,000 square feet is going to be like 5+ units. Yeah. So now I have 1,235 apartment buildings in the city of Houston that fit that. And so I can go, let me see. These unit numbers usually are indications of condos, but I don't want to see that. I want to see actual buildings. So just give me 1 second when I find something. Let me get rid of these unit numbers. Let me do something to the, let's do, if I do minimum 10, maybe that should knock out those condos. No, it's not doing that. Okay, that's the wrong one. Let's see. First stories, let's do 3. Sometimes you got to play around with this so I can just find you guys what I'm trying to show you. All right, you know what? I'll just click on this anyway. So I come here, it shows me the owner of the property. It shows me if it's on market or not. So this one is on market, or it was on market. Oh no, so this isn't on market, but it's showing that the units are going for $1,400 a month. I can go to mortgage and transaction history and see how much they purchased the property for, when they bought it. So this helps you with when you're negotiating with a seller, because I know how much you paid for it. I know how much is on your mortgage. I know what your mortgage payment is. So you can't lie to me and try to finesse me and make me think a certain way. And I can also pull up the actual document numbers of your mortgage. I can pull up the paperwork of your mortgage and see every single term that you have in your mortgage. That helps you negotiate. Then you can pull comps. Comps basically lets you know what properties in that area are going for, what the average price is. And for this, there are no comps for that property because it's an apartment building in probably a residential area. So it's the only property within a mile that went for that amount. Linked properties, I can see all the other properties that that owner has as well. So that building that they own, these are all the other properties that they own. And how much they paid for it, or how much is left on the balance of the loan. And so it allows you to really just be able to do your due diligence to find out what's going on. Now, if I try to go to Zillow, this is gonna be funny. And I type Houston, Texas. You do not need to be good at English to be a good real estate investor. It's okay, guys. And I try to say, show me a multifamily. It's only going to show me properties that are max 4 units. It's not going to show me 10 unit and 15 unit apartment buildings. It's going to show me stuff between 1, 2, 3, 4 units. So that's why I say stay away from the free sites. If you really are serious about being a real estate investor, invest into a platform or a software that's going to really help you do what you need to do, which is find those deals. So,
That makes sense.
how do I get back into this thing? Hold on. So, uh-oh.
What's your take on dot loop?
On what? I'm sorry, you said?
Dot loop.
Dot loop?
Yep.
Isn't that the online like e-signature thing? Just like sign stuff?
I'm sorry, what is it called?
He means that, yeah.
Yeah.
Oh, Loop. So in the real estate industry, we say LoopNet is where deals go to die. Every deal you see on LoopNet is a deal that couldn't be sold, and so they take it to LoopNet, and they're usually the worst deals. They're the worst. That's why they go to LoopNet. So yeah, I mean, I think LoopNet is a good place to go to find commercial brokers, but to find deals, I would never look for a deal on LoopNet. Any deal I saw on LoopNet, I'd automatically look at it as a bad deal. And when you look through the numbers, they're usually terrible deals. But brokers, you can find great brokers on there, and they can help you find something that's off market or that's a better deal. But yeah.
So for some of our audience that doesn't know what LoopNet is, can you just briefly explain what that is?
Yes. So LoopNet is basically the Zillow equivalent, but for commercial real estate. So the way you go on Zillow to find, a house or a 2-family or 3-family or 4-family, you would go on LoopNet to find an apartment building, a 10 unit, a 5 unit. But they're the worst deals ever. You I'd be very, very, very cautious trying to buy a deal off of there. You could, end your career before it starts by buying a bad deal.
So we have another question from, let's see, Ife Olayemi. What has been your biggest challenge so far in this business?
The biggest challenge, I guess it would be, the biggest challenge. That's a very hard question, but it's a good question. I'll probably say the discipline as far as knowing when to execute.
Okay.
Because we are looking every deal that I'm, looking at, I'm potentially going to sink anywhere from $40,000 to $130,000 into that deal. So sometimes like you're conscious, like, oh man, that's a lot of money, and you want to double check and make sure, okay, the numbers are right. You want to make sure that number one, the seller gave you like the correct information and they didn't give you BS information. And so you're just double checking, and it's just, so sometimes it's like, okay, execute, like go. And so sometimes when you're looking at so many deals, sometimes you kind of get stuck at to say, okay, which one do I actually pull the trigger on? Because these all seem to be great. I've done my due diligence on all of them, but I can't buy all 7 of them. And so sometimes that's kind of hard as far as knowing which direction to go. I guess that's a good problem to have, having multiple deals to choose from. I wouldn't necessarily call that a difficulty. I would say it would probably be building the track record, to where you can now get deals done on your terms instead of the lender's terms. And that comes with doing a significant amount of deals over time. And now you have the leverage to tell the lender, I want to do this deal at 4%. And if you don't give me 4% interest, I'll go to the next lender, because I've done this 12 times. I got a portfolio that's kicking out over 150,000 a month. I've shown that. So you can either take my business at my terms, or I can go somewhere else. So getting to that point to where you can now do deals at your terms, that is definitely an uphill battle. I saw that it was important because I saw a guy who was telling his lender that he wants to put 0 down on a $30 million deal, and told the lender, was like, yeah, I'm putting 0 down on this deal. And the lender was like, all right. And I'm like, whoa, what the hell? But that's because he had built that track record and built such a huge portfolio with that lender. There's like, yo, we don't want to lose his business. So fine, you know what? We'll let you put 0 down. We'll make our money on the back and on the interest and the like. Yeah. And so that I would say is the hardest thing for me, is just getting to that track record level to where you can now dictate the terms of your own deals to the lender, and that allows you to grow a lot faster. So that's been, somewhat of a challenge.
So my follow-up would be, how do you, what do you categorize as a good deal? Especially when you first started, right?
Easy, yeah.
What are some of the things, the metrics you're looking at to say, okay, that's a deal that makes sense, or nah, this is something I shouldn't go into, I should look for better deals?
Gotcha. So this is the easiest layman's way, dummy-proof way to analyze a deal. I hate when people make this thing sound so complicated and start using all these terms. Whatever your down payment that you're sinking into the deal, if after paying your mortgage and all your expenses and all that stuff, you can get your down payment back within the first year to 18 months, that's a great deal. That's the deal you should get into. If I can get all my money out of that deal, get it back within 18 months or even 2 years, great deal. I don't need to know all the funny calculations or whatever. If I put $40,000 into this deal and I'm making, let's just say $5,000 a month net after all expenses, then that means 5,000 times 12, 60 grand. So in 1 year, I got my 40 grand back plus 20,000 after all my bills being paid. That's a good deal. So of course, the shorter time, easier. But I mean, up to 2 years is fine. You know, I wouldn't pass on a deal because you're not getting all your money back in a year. If you can get it all back in 2 years, that's still a good deal. But yeah, that's one of the easy, quick ways to analyze a deal. Can I get my money back in 24 months? Now, as we dig deeper, there may be other things that we want to make that factor in or whatever. But if I can look at that on paper and see, according to the numbers, I can get my down payment back in 2 years, I'm going to look deeper into that deal and do due diligence. I want to take it down.
So we're running very low on time. Are you still okay with hanging with us, or are you also pressed for time?
So I'm actually with my lady right now, and she's been waiting very, very patiently. And so I want to spend some time with her. She guys
Okay.
don't. But you guys can shoot me an email, tosin314@gmail.com. I'll put that in the chat.
Okay.
And yeah, if there are any other questions that people have,
Yeah, there's still tons of questions actually, but I figured, to be respectful of your time, just to kind of, bring that up.
Sure. So hey, it was a pleasure being here with you guys. I hope I was able to make things less scarier for people, because I promise you, this whole thing is not rocket science. And I really dislike when certain gurus try to make it sound so difficult. And then that gives us analysis paralysis to where we don't make the move. So I just want to empower everybody and make everybody feel more at ease with getting into bigger deals without, making it seem so scary.
Tosin, sorry, before you go, I apologize. Just want to say thank you for joining us. Before you go, really quick, we like to ask our speakers for a last thing called common sense finance. Mm-hmm. If you can just give us a good say goodbye to us, we really appreciate that.
Yeah, so a common sense finance tip is to keep your credit score high. Okay. Keep your credit score high. We're in the United States, everything runs on credit. Forget your savings, whatever, credit. Keep your credit as high as possible, and you'll be able to do a ton of things. And there's so many ways to utilize your credit in so many other avenues, not just getting mortgages. If you have no money, but you have a high credit score, you can use your credit to get a loan and use that loan as a down payment on a mortgage, or as a down payment on a mortgage to buy an investment property. So having the credit is really the key to getting you in the door with not using your own money. So credit.
All right. Thank you so much. We really appreciate it. And we'll talk soon.
All righty. Take care, guys. You guys have a great evening.
All right. Thank you guys for joining us today. Once again, this is African Business Club. We apologize for not be able to get to everybody's questions, but we usually continue our conversation on Tuesdays. It's called Talk to Us Tuesday. So what we will do, we'll try, not promising, but we'll try and see if we can get Tosin back to join us on Tuesday. However, even if Tosin doesn't join us on Tuesday, we have a whole lot of people experienced in real estate in African Business Club. I know at least 2 people personally that have done a bunch of deals also that are actually on this call right now, and they will also join us on Tuesday. So if you have any questions, come on Tuesdays, let's discuss it, let's talk about it. So the conversation so it doesn't have to end here, and any questions you have, you can bring it on Tuesday, or any suggestions that you have or anything you want to add value to, bring it to us on Tuesday, usually at 7 p.m. Eastern time. We'll send the link out. And for those that join us for the first time, and everybody that joined us today, I want to say thank you. This African Business Club, our goal is to normalize financial literacy and promote collaboration among Africans. And we're on Discord. It's just a group for us to share information, share ideas, bunch of information shared there every day. We just posted the link on the chat, so join us, check it out. And this video, which we do with every video, this one we record it and usually we post it on our YouTube page. So check out the YouTube page. We have other videos, other sessions that have been posted. So we have tons of good information. This information is just, we bring these speakers for different topics, but it's whichever topic resonate with you. So please follow up, follow through, connect with people, collaborate with people on the group that have similar interests, and let's just do big things. Let's all win together. And our next discussion will be December 20. So all year we've talked about financial literacy, building assets, but our next topic will be how to protect yourself. So like the